All right, today we're diving into a really interesting one, Quantum Computing Inc. This is a company that's right at the heart of what could be a massive technological revolution. But the big question is it a brilliant investment or just a huge gamble? We're going to break down the two very different sides of this story. And this is really the core of it, right here. On one side, you've got Wall Street analysts looking at this thing and seeing almost 30% growth potential. But on the other side, you've got critics calling it a cash furnace and wondering if the stock is going to crash down to just $2. So what's the real story behind QBT? That's what we're here to figure out. So before we even touch the company's stock, we got to understand the big picture. To get why there's so much hype and so much money flowing into a company like QBT, you first have to appreciate just how massive the promise of quantum computing really is. And look, this isn't just about making computers a little bit faster. We are talking about a complete game changer, a technology that could solve problems that are literally impossible for today's computers. Think about it, creating super efficient energy grids, designing batteries that could revolutionize, well, everything, and even developing ways to pull pollution right out of the air. It's huge, and it could totally redefine fields like AI and cybersecurity. Okay, so this is where Quantum Computing Inc., or QUBT, comes into the picture. Their secret sauce? They use something called integrated photonics, which is basically a fancy way of saying they use light on a tiny chip to do their quantum magic. Now, why is that such a big deal? Well, a lot of their competitors need these massive, super cold, crazy expensive machines to work. QBT's whole approach is designed to work at room temperature. If they can pull that off, it could make this incredibly powerful technology way, way more affordable and accessible to everyone. So you see the potential, right? It's massive. But how in the world does Wall Street look at a company that's still so early in the game and say, yeah, let's bet on that? Let's get into the bull case. The first thing you see is the consensus from analysts who've been digging into this, a moderate buy. Now, that might not sound like a screaming endorsement, but for a field this new, where you can't just look at last year's sales figures, a rating like this is actually a pretty strong signal. It's a sign of measured confidence from the pros. And they're not just saying it's a good idea, they're putting numbers on it. Based on their models, they see a potential upside of almost 30% from where the stock is now. That's a pretty bold prediction, and a clear sign of confidence that they believe there's a lot of room to grow. And that prediction leads them to an average price target of $32 over the next year. You know, for an investor, a target like that is like a lighthouse in the fog. It's Wall Street's way of saying, this is where we think it's headed. But of course, that's only half the story. It's never that simple, right? For every optimistic analyst, there's someone on the other side waving a huge red flag. So let's flip the coin and take a serious reality check with the bear case. And the critics aren't pulling any punches. Forbes just comes right out and asks it, how could this stock fall all the way to $2? They're basically saying that for all the futuristic promise, there are some very real, very scary risks right here, right now. They lay out 5 big reasons why. First, the tech is cool, but it's not actually making much money yet. There's a huge gap there. Second, you've got giants like Google and IBM in this space. That's some serious competition. Third, and this is a big one, they are burning through cash like you wouldn't believe. Fourth, to get more cash, they keep creating new stock, which waters down the value for everyone who already owns it. And finally, when the market gets nervous, super risky stocks like QUBT are often the first ones people sell. And if you want to see what that cash furnace really means, just look at these numbers. In 2023, the company brought in about $263,000 in revenue. Okay, but they lost almost $30 million. That enormous gap is the price of being a pioneer, right? You're spending a fortune on R&D, on brilliant people, and on equipment, all before the real money starts rolling in. So, how do you plug a $30 million hole? Well, you sell more of the company. This recent announcement to raise $750 million by selling new stock, that's the dilution risk we were just talking about. It means there are more slices of the pie, so your slice gets smaller. Okay, so we've heard from the optimists and we've heard from the critics. But to really get to the bottom of this, we need to ignore the noise and go straight to the source. Let's see what the company says about itself in its official paperwork. See, every year, a public company has to file this document called a 10-K. And in it, they are legally required to tell investors all the things that could go wrong. And what QBT admits, well, it's pretty eye-opening. It's fascinating, really. The company basically confirms what the critics are saying. They come right out and admit that, hey, a commercial market for this stuff might never actually show up. They say the industry is brand new and super volatile, and they acknowledge that growing the business is a massive challenge, especially when you're up against the biggest tech companies in the world. But honestly, all of that pales in comparison to this next part. This is the real bombshell. It comes directly from the company's own auditors, and you really can't get more serious than this. It's a going concern warning. In plain English, that means the auditors have substantial doubt that the company can even stay in business. For any investor, that is the biggest, brightest red flag you can possibly see.
So you put it all together, and what do you have? You have the classic investor's dilemma: high risk, high reward.
On one side, you have this incredible, world-changing technology. It's a chance to get in on the ground floor of what could be the next massive revolution, and analysts think the stock has plenty of room to run. But on the other hand, you've got jaw-dropping financial losses, monster competition, and a formal warning from the company's own accountants that it might not survive. So the decision to invest isn't just about the technology. The real question is, how much of a gambler are you?